It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And welcome back to another Real Estate Podcast right around Australia 7 days a week as we talk your property news and information from Toowoomba in Queensland to the suburb of Double Bay in Sydney. And good morning if you are in either of those locations. We are blasting out on multiple platforms, including Spotify this morning and Amazon, where it is a Thursday. Look at that, into double numbers, April the 10th. Now, despite more women joining the workforce and dual income households becoming the norm, housing prices in Australia, as we know, have surged far beyond what most families can afford. According to new data reported by Domain yesterday, national median dwelling prices have jumped from 4 times the average household income back in 2001. Wouldn't you love to be back in those times? To now over 8 times in 2024. Of course, in cities like Sydney and Brisbane, the gap is even wider. But why is this, you ask? Well, it all sort of centres around critical shortage in new housing construction. That is the key driver of rising property prices, alongside the growing wealth of some households that, simply put, are allowed to outbid other property buyers. And commentators and economists are saying the same thing. The answer to Australia's 11 trillion property market challenge is to build more homes. Yes, we've got to build our way out of this mess. As we take you to Perth right now for his thoughts on the property market there, your regular commentator on the WA real estate market scene, it's Matthew Hughes, the Managing Director from Capital Property Advisory. And welcome back to you, Matthew, to the Real Estate Breakfast. How is you back? I know that people will be wondering, how are you going, or are you still broken down?
No, I've made a bit of a recovery. I'm probably back at about 90% and into the mobility and rehab at the moment. So just chomping at the bit to get back into the gym properly. But it's been a frustrating few weeks, to say the least.
As I said, wouldn't it be nice to be back in 2001 for people buying properties, just 4 times the average household income? That's a long way away from where we are now.
It is, yeah. I bought my first place when I was 19, just before that time, and I think it was $95,000, which at the time was probably around 4 or 5 times my income.
Yeah, and that's the very reason you got into the market. Well, a lot has shifted, of course, on the global and domestic economic front. One of the more notable developments is now widely accepted. This is the expectation of multiple interest rate cuts by the Reserve Bank. What rationale do you think have contributed to the sudden shift in sentiment from the RBA and the broader financial community?
Yeah, it's quite a swing from a few weeks ago. The rhetoric from the RBA a few weeks ago was not as bullish on additional rate cuts in the near term. And we've probably seen that in our lead flow here with the election coming up locally, with the Trump tariffs, and then no rate cut in the April meeting. We've seen a bit of a slowdown from investor inquiry, which is typical of a pre-election cycle. But I think beyond this news and sort of, I guess, all the media we're seeing about multiple rate cuts, that's the expectation from the markets and from most economists that I'm reading about. I'm seeing predictions anywhere between 3 and 5 cuts in the coming year. Most estimates were totaling either side of maybe it's probably around 75 to 125 basis points at the most bullish end, and that would bring the cash rate down potentially to around 3.1. So I even saw someone predicting a cut of 50 basis points in the next meeting in May. So it'll be interesting to see whether that actually plays out. That expectation is being driven obviously by the escalating global trade tensions. The recent tariffs imposed by your friend President Trump they've heightened fears of a global economic slowdown. And I think international uncertainties have led to market volatility in the share market space. And that's prompting the RBA to consider monetary policy adjustments to bolster that domestic economic stability.
Yeah, no, that's good points that you're making, because the trade tariff war, that will be the reason if we go down 50 basis points without any shadow of a doubt. So if the anticipated interest rate cuts do materialise as predicted, how could this, do you think, influence the trajectory of the Perth housing market specifically?
Yeah, look, Perth's market, as you know, has been through a pretty robust period of growth, and it's been driven by excess population growth and demand, and obviously low stock levels. So that imbalance has resulted in a lot of price growth, lower vacancy rates, and that's put upward pressure on rent. So it's been a bit of an investor haven for some time. And whilst demand has softened and stock levels are very slightly higher, the imbalance remains, and Perth's still very much a seller's market. I think the anticipated rate cuts are likely to further invigorate the market here and in other markets around the country, and I think it'll make home loans more affordable for both investors and owner-occupiers for at least a period, in terms of the fact that it's going to open up borrowing capacity, and it's going to allow people to enter the market where perhaps they couldn't from a serviceability perspective previously. But the flow-on effect of that is that it's going to increase housing prices and offset that benefit. So anyone considering a purchase in Perth or most other markets around the country, I would suggest that you treat it as an urgent matter and try and get in there as quickly as possible before the impact of these potential rate cuts, if they do happen, is realised.
Yeah, and beyond Perth, there are several other markets currently attracting heightened investor interest, including the likes of Melbourne, which we've talked about, Darwin as well, and a number of key regional hubs across Queensland. So let's look at the projected effects of the RBA's potential rate cuts on these markets. Could we see similar growth patterns based on their individual market dynamics?
Yeah, look, I think Melbourne's market will definitely be a beneficiary of this. It's been through a long period of underperformance in comparison to other capital cities, and was already poised for a rebound this year. And it appeared to kick off with the first cut in February, with a couple of good growth figures from CoreLogic over the last couple of months. I was originally predicting a slow and steady recovery in Melbourne over an elongated period, but I think this will probably pour fuel on the fire in Melbourne, and I think it'll be a very strong 2025 for that particular market and Victoria in general. And then I think in terms of the other markets you mentioned, Darwin, I think, is going to have a very good 2025. I think it was going to anyway. And regional Queensland was also expected to experience solid investor demand and good growth this year. I think they're definitely markets to watch in 2025 because they've already got strong yields, and you couple that with a significant reduction in lending costs, and that could create quite an investor hot market. Having said that, time is of the essence, as I mentioned before. So if you're considering these locations especially, I'd be looking to get in there as soon as possible, and I'd be very cautious with your asset selection in both markets, given that you've missed the beginning of the cycle in both, probably more so regional Queensland than Darwin I'm talking about there. And also think the cuts coupled with the upcoming Olympics in Brisbane and all of that entails in terms of infrastructure spend and economic benefit, I think that will result in a second win for the Brisbane metro market, but not across the board. So again, be selective where you buy and what you buy at that point in the Brisbane cycle.
And we are talking to Matthew Hughes there in Perth, giving us a little bit of a lay of the land this morning. We'll come back and continue talking about these interest rates next.
If you're a new listener, welcome. We talk to the most knowledgeable real estate experts across Australia every day from 6 a.m. Let's explore together the power of real estate.
And it is a Real Estate Thursday right around Australia, but we are concentrating in Perth this morning with Matthew Hughes. And Matthew, while the lower interest rates can boost borrowing power and also stimulate market activity, are there any potential risks here or downsides, particularly for first-home buyers or investors in markets like Perth?
Yeah, like with anything, there's pros and cons to all of these things. I think lower interest rates reduces borrowing cost, expands borrowing capacity, and that's going to be a good thing for people who act early. But it'll also lead to increased competition is the next thing that we'll see. So that's going to, more competition, more demand is going to continue to drive prices up at a rate that was probably not what I was thinking a month or so ago. And that's probably across the country in most markets, not just in Perth. And whilst the coalition government is committed to APRA, to having APRA reduce the serviceability buffer, which we've spoken about previously, they're looking to reduce that from 3% to 2.5% if elected. I'm not sure that would be prudent anymore if we do get the depth of rate cuts that they're sort of estimating out in the markets there at the moment. And then in markets like Perth, which are still affordable relative to incomes and other major capitals, this could really enhance upward pressure on pricing, making it more challenging again for first home buyers to enter the market. So if you are that sort of buyer, either an investor or a first home buyer, again, I would say treat it with a little bit of urgency. And so you can get in ahead of that projected growth and then get the benefit of those lower borrowing costs. And as we've spoken about previously in terms of my predictions for the Perth market this year and into next, I think those who already own properties are going to benefit most from this. They're already sitting on high levels of equity if you've held that property for at least a couple of years. And then you couple that with increased capacity to borrow, and those people will be now looking to upgrade to their aspirational home or their aspirational suburb or both. And that's going to drive prices up through the market. And I think this time pushing up into the luxury end. And we're currently reviewing our research at the moment in light of all of this. And I think at the end of it, I'm likely to take a more bullish view on Perth in the balance of this cycle than I expected to a few weeks ago. And whilst we still favour Melbourne and Darwin potentially for our clients, we're looking into that at the moment as well. I think Perth still offers lower costs and higher yields than Melbourne, and definitely more stability and long-term potential than Darwin.
Yeah, that word stability, hard to sort of conjure up that word too much with these trade tariffs going on. I didn't realise Trump apparently said to his aides, go and find me somebody that likes what I like, and that is these trade tariffs. And that's when they found this guy, Peter Navarro, and he was part of the first 1.0 term of Trump, and he's kind of like the architect of it all. It's just incredible, isn't it, how one person can be so dominant on a global stage. And trade, of course, is just monumental when it comes to the economies around the world.
Yeah, look, it's interesting to watch play out. Most intelligent people that I've listened to about tariffs are all of the understanding that it's not going to achieve the outcome that he's hoping for. So then you have to wonder what is the actual outcome that he's hoping for, which we spoke about off air earlier, and wonder whether he's actually playing a different game for personal benefit and benefit of his friends. Look, in times like this where there is uncertainty, Australians have historically moved away from share markets and into property. So if that happens again now, and if they're seeking that stability of bricks and mortar, we might see even more demand pile into the housing market.
Yeah, bricks and mortar, and fair to say gold at the moment is looking pretty attractive.
It is, yeah. Look, gold's been on a bit of a tear lately with all the instability, as is the case historically.
All right, well, we'll wrap it up there, Matthew. Yes, looking for stability would be nice. Enjoy your Thursday there in Perth.
And you, Craig, great to be with you.
It's the Real Estate Podcast, talking properties from 6 a.m. every day from every corner of the Australian real estate market.
Auctions aren't really huge in South Australia like they are in the eastern states, though. So I think they only account for about 9 to 10% of our sales down here.
It is good news for tenants because if you're thinking about getting a pet, landlords can't just say no now without giving a valid reason anymore. So tell us a little bit about that rule change.
Yes, that's correct. It came in on the 1st of July last year. We were fully expecting it, and it was basically bringing us into line with all the other states around Australia. But pretty much now, if a tenant is living in a property and wants to have a pet, they can put in an application to the landlord, and the landlord can only say no under specific grounds that are listed in the legislation.
Where are the numbers that you're looking currently for seeing this sort of turn into a reality?
Right now we're tracking at about 44,000 a quarter, so we're 15,000 houses down. Labour shortages, construction costs on the one hand are impacting that, and the incredibly high migration numbers as well have impacted the demand side, making those numbers even starker in terms of the shortfall in that target.
We connect you to the best real estate information across Australia. The Real Estate Podcast.